Good morning, and thanks very much for the opportunity to be here with you today at the Institute's premier event. Let me start by saying APRA has very good relations with all industry institutions, associations we engage with, but our connection with the Actuaries Institute is closer than most. I think that's because APRA and the Actuaries have a great deal in common. We specialise in managing, identifying emerging risks. We aim to rectify problems before they cause harm, rather than trying to fix them once the damage is done. And we have a commitment to not just the soundness of individual companies, but to the interests of the community and the greater good. It should be no surprise then to hear that APRA employs many actuaries, including my fellow Deputy Helen Rao, who looks after super, and that we highly value submissions from the Actuaries Institute to our various consultations. As ex-ante risk managers, both APRA and Actuaries face the challenge of evolving in response to changing circumstances in the Australian financial sector, including those driven by the Hayne Royal Commission. As I noted recently in a speech to the Insurance Council of Australia in February, too often the misconduct or poor industry practices highlighted by the Royal Commission were well known, yet companies had failed to address them. In many instances, that was due to short-term financial gains from practices such as charging fees for no service or relying on outdated medical definitions. As we have seen, companies have paid a high price in the long run. Financial sector trust is now tarnished, while banks, insurers and superannuation licensees face a lengthy period of heightened scrutiny, increasing the possibility of further reputational damage. Amid clear evidence that risk management remains weak in financial institutions, it is apparent that boards and senior managers need a stronger, a louder and more insistent voice on their shoulder, urging them to think again. Someone senior and trusted, someone independent, someone with expertise in identifying and assessing risks. And I think by now you can probably see where I'm heading. In a matter of weeks, APRA's new cross-industry standard CPS 320, Actuarial and Related Matters, comes into effect. APRA is introducing this standard to strengthen the influence of the appointed actuary in life, general, private health insurers, especially on the most material matters. My message today is that this influence cannot be confined to traditional financial risks, given the substantial damage to prudential soundness that can arise from the poor management of non-financial risks. Actuaries must find the story behind the raw numbers and then have the courage to speak up. To do this, they then will truly fulfil their role of assisting with the sound and prudent management of an insurer and ensuring protection of policyholder interests is adequately considered. In my remarks, I don't want to imply that actuaries' traditional focus on financial risks has become less important. The financial environment remains a challenging one for many APRA-regulated entities, especially in the insurance space. Private health insurers, in particular, face the challenge to their long-term viability, reflecting declining affordability, driving down membership, especially among the young and healthy. Life insurers have been adversely affected by a surge in mental health-related claims, taking heavy losses on disability, income insurance, and they will need to adjust to important superannuation reforms aimed at consolidating accounts. General insurers have paid out more than $1 billion to policyholders in Townsville floods, while banks and superannuation funds face their own pressures to perform. But on the whole, the issues that have caused industry the most grief over the years stem from the failure to identify and mitigate against the effects of non-financial risks. A little over a fortnight ago, APRA released a paper analysing the findings of 36 self-assessments by some of the country's leading banks, insurers and super funds. We wrote to their boards last year asking them to conduct the self-assessments in light of the CBA Prudential Inquiry report. We wanted to gauge whether there were similar weaknesses that existed in their own institutions. Our analysis determined that they did, although not to the same extent and depth as the CBA. Among the most consistent themes to emerge were that non-financial risk management was frequently weak, and many of the issues raised were known to entities and were very long-standing. As a result of the self-assessments, we have intensified and more precisely targeted our supervision of entities. And in some cases, we're considering imposing additional capital requirements due to the materiality of the weaknesses identified. And that's the thing about non-financial risks. Left unaddressed, the consequences can become distinctly financial in nature. In the wake of the Royal Commission, our major banks have seen their profits eroded by the cost of remediating aggrieved customers and upgrading or putting in place systems to stop it happening again. The four major banks have collectively spent or set aside nearly $7 billion, and that number is likely to rise further. Failing to adequately manage risks relating to anti-money laundering and counter-terrorism financing laws saw our largest bank fined $700 million with AUSTRAC. Overseas, successful cyber attacks have caused major financial and reputational damage to some of the world's largest companies, including Yahoo, Marriott and eBay. APRA has warned repeatedly that it's only a matter of time before an Australian bank, insurer or super fund falls victim to a cyber attack. And in a worst-case scenario, that attack could threaten the entity's viability. The need to manage non-financial risks is not new, however. Cyber attacks have been a threat for decades, but the range of risks and the speed with which they can undermine the prudential soundness of a business have perhaps never been greater. Much of this relates to technology and the proliferation of online news and social media. Former APRA Deputy Chair Ian Lachlan and current Actuary of the Year made this point last year in an article with the Institute. He wrote that society's tolerance for egregious practices is much lower than it once was, while society's ability to see and to call out unacceptable practices and to highlight poor outcomes is much more powerful. With financial sector trust damaged, it only takes one media expose or social media outcry to cause a company serious financial damage, often in the space of days, hours, rather than weeks or months. In the aftermath of the Royal Commission, financial sector companies face the additional threat of regulators, with a lower tolerance for misconduct or poor risk management and a higher tolerance for exercising their formal enforcement actions, including litigation where appropriate. Our colleagues at ASIC are now asking why not litigate when confronted by breaches of the law, and they've demonstrated several times over the past year that they're not bluffing. APRA is also moving on unacceptable practices. Last month, we launched our new enforcement approach, including a commitment to adopt a constructively tough appetite towards enforcement action. As a prudential regulator rather than a conduct regulator, APRA will still focus on preventing harm with the use of non-formal supervisory tools. However, we will be less patient with the time taken by uncooperative entities to remediate issues and more forceful in expressing specific expectations and prepared to set examples that are public to seek deterrent effects. Added to this, entities must also contend with the Bank Executive Accountability Regime, or the BEAR, which applies to all ADIs from 1 July. and will soon be extended to cover insurance and superannuation. Not only does this regime make boards and executives, including potentially senior actuaries, more accountable for their individual performance, companies themselves face penalties for failing to meet their obligations under the BEAR or whatever threatening sounding acronym is created for the insurance and super sectors. In short, the consequences of failing to properly identify, assess and mitigate risks, especially non-financial risks, are higher and potentially more expensive than they've been for many years. In such a high-risk environment, the role of the appointed actuary becomes more crucial to protect both the interests of the institution and its customers. Unfortunately, APRA has held concerns over recent years that the influence of the appointed actuary has been downgraded in many financial institutions. Rather than acting as an independent voice of wisdom and challenge on the most material concerns facing institutions, we received feedback that the appointed actuaries were being worn down by compliance obligations. Turnover was increasing, tenure was declining, as was seniority, as the role got pushed further down the corporate hierarchy. To address our concerns, the potential flow-on effects for risk management, APRA embarked on a consultation in 2016 to streamline and sharpen the role of the appointed actuary in general and life. Midway through the consultation, we expanded the scope to include private health insurers, recognising that many of the issues existed in all three sectors and that there were benefits in harmonising the prudential requirements in a new cross-industry standard. The outcome was the new prudential standard CPS 320, which takes effect from 1 July. One of the most important parts of the new standard is its purpose statement, which guides the role and relationship with the board and senior management. It states that the purpose of the appointed actuary is to ensure that the board and senior management have unfettered access to expert and impartial actuarial advice and review. With that in mind, APRA has designed the new standard to make sure that the voice of the appointed actuary is appropriately prominent in institutions and able to act as a trusted advisor to the board. Other provisions in CPS 320 are aimed at giving appointed actuaries the flexibility to work with insurers to design a framework for obtaining actuarial advice that suits their business. We want appointed actuaries to have the discretion to delegate so they can focus on the most relevant matters and not be weighed down by a ticker-box approach of considering a set list of matters specified in a prudential standard. Although an important step in reinforcing the appointed actuaries, a prudential standard can only do so much. APRA has provided the platform and handed over the microphone. Actuaries need to turn it on and speak up. To be truly effective, actuaries must be prepared to probe, test and challenge boards and management about the wisdom of their decisions and potential risks they may not have fully considered. Vitally, actuaries need the ability to do this beyond the realm of traditional financial risks. We want them to broaden their thinking about what constitutes a financial risk into areas such as culture, governance, remuneration and consumer outcomes. This applies not just to appointed actuaries, but all actuaries across APRA-regulated entities. Now, a reflexive reaction might be to argue that we're asking actuaries to go beyond their training and expertise. But I don't think that's the case. APRA doesn't expect actuaries to be running their eye over marketing campaigns or signing off board appointments or conducting staff surveys seeking signs of poor culture. We understand that actuaries are focused on numbers, but numbers can tell a story beyond simply profit and loss. If a particular policy that your insurer sells pays out less than 20 cents in the dollar of premium raised in claims, What does that suggest to you about the value of money for policyholders? If your life insurer is taking an average of 8 months to pay death cover claims or accepting only 1 in 4 total and permanent disability claims, does that raise alarm bells for you? We don't expect actuaries to always know what the precise story behind the numbers is, but we do believe that they need the nous to recognise that there might be a problem and the courage to push boards and senior executives to examine and address it. I've personally seen this sort of actuarial influence in action. In my previous role at the Treasury, I worked closely with the Australian Government Actuary and saw firsthand the invaluable contribution they were able to add to discussions around some of the most vexing and contentious policy questions the country faces: retirement incomes, ageing population, on welfare and health expenditure, defence and national security. APRA's evolving approach. Before concluding, I'd like to provide an update on some of the work that APRA is undertaking, especially on the management of non-financial risks. This is an area where APRA has stepped up its focus in recent years, especially in the wake of the GFC, as it became clear that poor culture and a lack of accountability were major drivers of the downturn. Last year, we released a review of executive remuneration practices at large financial institutions, and we will shortly follow that up by releasing draft changes to the prudential framework to strengthen the management of that issue. You can expect it to propose longer vesting periods, greater scope for malice and clawback, and less focus on short-term financial metrics in setting variable remuneration, as part of our efforts to ensure incentives are appropriately structured and there are meaningful consequences for individuals when poor outcomes arise. Our new Information Security Prudential Standards, CPS 234, takes effect from 1 July. It will shore up entities' resilience against the risk of cyber attack, and we will shortly be releasing updated prudential guidance in this area. We've stepped up our supervisory focus on the management of climate risk, and we intend to review our cross-industry governance and risk management standards this year to ensure they encourage a sharper focus on non-financial risks. We've started looking at how to refresh our guidance on superannuation licensees around environmental, social and corporate governance. On the Royal Commission, we continue to gather evidence on each of the 12 referrals that have come to APRA, and we expect to make an assessment on the merits of taking further action in coming months. With respect to the 10 recommendations which fall within APRA's responsibility, we released the first proposed policy changes in respect of land valuations, particularly for agricultural land, in March. Other actions remain on track against the action plan for each recommendation that we published in the week after the final report was released. APRA's heightened focus on the management of non-financial risks does not in any way diminish the responsibilities that boards and management have for the performance of companies they oversee. APRA will not be determining what executives get paid. We will not be dictating what companies' corporate culture should be or prescribing the composition of their board. Our role is to ensure that companies we supervise have effective systems and frameworks in place that optimise their ability to meet the financial commitments they make to their customers. And like a good actuary, we intend to continually challenge boards and executives to ensure that the standards they aspire to are being met in practice and unnecessary risks are being avoided. In preparing this speech, I went back and read the June 2016 discussion paper that accompanied APRA's consultation on the role of the appointed actuary. The opening paragraph of the executive summary says, and I'll quote it, "The appointed actuary plays an important role by providing independent expert advice to boards and senior management on the key financial risks that an insurer has." 3 years on, that statement might seem slightly antiquated with no reference to non-financial risks, that have caused such damage to trust, reputation, profits and shared values. But as I have said, the term non-financial risk is arguably misleading. A failure to quickly identify, assess and mitigate against these risks, be it misconduct, weak governance or just poor customer service, can become prohibitively expensive. Just as APRA has needed to evolve its approach and update the prudential framework to put greater emphasis on issues of culture, conduct, governance and accountability, so must the entities we regulate. Newly empowered by CPS 320, appointed actuaries can play a key role on taking a broader view of what represents a financial risk. But all actuaries can benefit by adopting this mindset. In an environment where financial entities face sharper scrutiny and steeper penalties for mistakes, actuaries must find the story behind the numbers, ask boards and management the difficult questions and be prepared to challenge them if dissatisfied with the answers. Speaking out is not always easy, and a dissenting voice is not always welcome. Actuaries might find their voice is occasionally jarring for those whose decisions they question. Where actuaries need the courage to speak up, the companies they work for need the wisdom to listen and the foresight to act when the risks are presented. The numbers always tell a story, and it is far safer and less costly if it is uncovered by an appointed actuary, rather than an investigative journalist or a regulator with an enhanced appetite for enforcement. So that's it from me. Can I hand over now to Alan Kirkland, and thank you very much.